Solar energy. For the longest time, the narrative was purely environmental. It was soft. You put a few panels on your roof, you feel good about yourself, save the planet. But if you've been watching the markets lately, you know that narrative has completely shifted.
Oh, completely.
Solar isn't just about being green anymore. It is an industrial heavyweight. It involves massive supply chains, geopolitical maneuvering, and frankly, some very complex financial engineering.
It's absolutely gone from a niche alternative to, well, the backbone of the global energy transition. But for investors, that transition brings a whole new set of headaches. It's no longer enough to just ask, is the industry growing? We know it is. The real question is the specific company you own actually capturing value from that growth? Or are they just, busy spinning their wheels?
That is exactly what we are figuring out today. We are popping the hood on a major player in the Turkish energy sector.
Welcome.
Today, we are focusing on CW Enerji Mühendislik Ticaret ve Sanayi. We are stripping away the jargon from their 2025 annual report to see if this company is actually generating heat for retail investors or just blinding them with shiny revenue numbers.
And we have plenty of data to sift through. We are looking at the audited, consolidated financial statements and the 2025 activity report ending December 31st, 2025.
It's a dense read.
It is, but that's why we're here.
Before we get into the billions involved here, we have to address the elephant in the room regarding the math itself. These numbers aren't standard, are they?
No, they aren't, and this is crucial. Everyone listening needs to understand that these figures utilize TMS 29. That's inflation accounting.
Okay.
Because Turkey has been navigating a high inflation environment, every number we discussed today has been adjusted for the purchasing power of the lira as of the end of 2025.
So when we compare this year to last year, we aren't just seeing the price tags get bigger because of inflation.
Precisely. Think of TMS 29 like cleaning a dirty window. It wipes away the distortion caused by inflation so we can see if the company actually grew in real terms.
Or if they just rode the inflation wave.
Exactly. The growth we discussed today is real growth.
Okay, window cleaned. Let's first get to know the company a little. Who exactly is CW Energy?
They are a heavyweight. Founded in 2010, their headquarters and main production facilities are located in the Antalya Organized Industrial Zone, specifically in Döşemelti.
Right.
But if you think of them just as a panel maker, you are missing the bigger picture.
Right, I was looking at their product list. It's not just the PV panels.
No, they have positioned themselves as a full ecosystem provider. They manufacture the photovoltaic panels, yes, but they also sell inverters, energy storage systems.
And they're heavily into EPC.
Heavily. That's engineering, procurement, and construction.
Meaning they don't just sell you the hardware, they will build the power plant for you.
Yeah. Exactly, and they've expanded that ecosystem aggressively. They are into EV charging stations and even heating and cooling pumps now. They basically want to own every touch point of electrification.
And looking at the structure, they seem to have a subsidiary for everything. It's a complex web.
It is. They have CW International and TTAT AG handling things abroad, but the critical one we need to keep an eye on is CW Solar Cell.
Okay, why?
We will come back to that, but that is their play for vertical integration. They also have CW Storage for batteries and CW Energy USA to get a foothold in the American market.
They've been busy with acquisitions, too. I saw they bought a company called Mersin Hayvancılık in September 2024.
Yes, and they established Schaltkraft in October 2024, which focuses on transformer and switchgear work.
Ah, the essential stuff for connecting solar to the grid.
Exactly. And just recently, in 2025, they set up CW Kumsal to handle logistics and dealerships.
Though, to keep the record straight, they did trim some fat. They sold off CWSE Group and CWSE Management in 2025. So there is some restructuring going on.
Right. And the scale of this operation is impressive. In terms of production capacity, they produced 1,111 megawatts of panels in 2025.
That sounds like a lot.
It is a massive jump from 759 megawatts in 2024.
Wow.
To give you context on their size, based on 2024 data, they were ranked 299th in net sales on the Fortune 500 Turkey list. With this production jump, they are likely climbing that ladder fast.
Okay, so they are big and they are growing. But let's talk governance. For the retail investor holding the stock ticker CWENE on the B-Star market, Do they actually have a say in how this ship is steered?
That is a delicate subject. CW Energy uses a dual-class share structure.
I see where this is going.
It's common in family-founded firms, but can be frustrating for minority shareholders. There are A group shares and B group shares.
And let me guess, the retail investors don't hold the A shares.
You guessed it. The A group shares are privileged. They get to nominate board members, and crucially, they carry 5 votes per share.
5 votes.
B group shares, what you or I would buy on the exchange, get 1 vote and no nomination rights.
So the chairman and CEO, Tarzan Karyak Sarvan, essentially retains control regardless of how many shares are sold to the public.
Effectively, yes. And while we are looking at the board and management, there is a number in the footnotes regarding compensation.
Oh.
For key management personnel, which includes the board, the total wages and benefits in 2025 came to 44.4 million TL.
44 million, is that high?
It's about 33% higher than the previous year. Given the inflation adjustments and their operational expansion, it roughly tracks with the company's growth.
So a healthy paycheck.
A healthy paycheck, but not necessarily an outlier for a company of this size.
Let's pivot to the competitive landscape.
Yeah.
You mentioned they are vertically integrating. Why is that so important right now?
Because the solar sector is becoming a commodity market. When everyone can make a panel, the price drops and margins get squeezed.
Right.
The only way to survive is to stop buying expensive components from others and start making them yourself. That is why their subsidiary, CW Solar Cell, is the most important part of this report. They are moving to manufacture their own cells, not just assemble panels.
So if we did a quick SWOT analysis on the back of a napkin.
Sure, strength, huge capacity, and that diverse revenue stream, they make money on the product and the service. Plus, strong R&D in niche areas like agro-PV, which allows farming under solar panels.
Okay, weaknesses.
Weaknesses, cash flow. It is the Achilles heel of this business model, which we will see in a minute.
Opportunities.
Government incentives. Their investments in Italia get Region 5 tax breaks, which is huge for the bottom line.
Threats.
Threats. Raw materials. If silver or silicon prices spike, it eats their lunch instantly.
All right, let's get to the numbers. Now we can move on to our analysis. Again, for everyone listening, these are inflation-adjusted, real-term figures.
Very important.
Starting with the top line, revenue.
The number is 16.35 billion TL.
Which is up about 18.8% from 13.77 billion TL the previous year.
Correct. And remember, because this is inflation adjusted, that 19% is real volume growth. They sold significantly more product. Sales volume jumped from 791 MW to 1,081 MW.
So they are physically moving more boxes.
A lot more boxes.
Okay, so they are moving units. But are they making money on them? Let's look at gross profit.
Gross profit came in at 4.05 billion TL. Interestingly, their gross margin actually ticked up slightly to 24.78%.
Really? Up?
Yeah, compared to about 24.4% previously.
That's surprising. With all the competition, you'd expect margins to compress.
It shows they have pricing power, or perhaps their vertical integration is already saving them costs. However, if you look at EBITDA...
The operational cash engine.
Right, that was 3.17 billion TL. The margin there dipped slightly to roughly 19.4%.
So operational costs are creeping up a little faster than sales. But then I looked at the net profit and I thought I misread the zero.
You didn't. Net profit for 2025 was 2.21 billion TL.
Compared to 478 million the year before. Yeah. That is, what, a 4x increase?
Nearly a 5x increase. It is a massive jump. Consequently, the net profit margin jumped from roughly 3.5% to 13.5%. Earnings per share, EPS, skyrocketed to 2.054 TL. Okay,
stop. Let's unpack this. Revenue went up 19%. Operational profit was relatively steady. How on earth does net profit explode by 400%? Did they find gold under the factory floor?
This is where you have to be very careful as an investor. If you just look at the PE ratio, the stock looks incredibly cheap. But that profit didn't entirely come from selling panels.
Right.
A massive chunk, about 1 billion TL, came from deferred tax income.
Deferred tax income. Translate that for us.
It's an accounting calculation. Because they are investing so heavily and because of the inflation adjustments on their assets, the tax code allows them to book a benefit now that they will realize in the future.
So it boosts the net profit number on paper.
But, and this is critical, it is not cash that entered their bank account this year.
That is a massive distinction. It's paper profit.
Exactly. And that leads us to the reality check. Profit is an opinion. Cash is a fact.
I'm looking at the cash flow statement now. Specifically, cash flow from operating activities.
Yeah.
It's negative. Minus 20.9 million TL.
There it is.
That is a stark contrast. 2.2 billion in profit, but the actual business operations lost $20 million in cash.
Yes. And the culprit is right there in the working capital line. Trade receivables.
The money customers owe them.
It exploded to 5.7 billion TL.
5.7 billion. So they are shipping the panels, booking the revenue, recording the profit, but they haven't collected the check yet.
Precisely. They are essentially acting as a bank for their customers. In a high inflation environment, having 5.7 billion TL out on the street is risky.
That money is losing purchasing power every day it isn't collected.
You got it. And presumably they are spending cash to build these new factories at the same time.
Oh, massive amounts. Investment cash flow is negative 4.4 billion TL.
That's the capex.
They are building the solar cell factory, buying machinery, expanding capacity. They're spending real cash to build assets.
So operations aren't bringing in cash. Investments are draining cash. How are they keeping the lights on?
Financing.
They raised a net 4.7 billion TL from financing activities. This is a mix of loans and equity.
That brings us to the balance sheet health.
Yeah.
How leveraged are they?
It's rising. Total assets grew impressively by 40% to 28.6 billion PL. But looking at the debt status, short-term liabilities are now sitting at 11.3 billion TL. Long-term liabilities are at 3.4 billion TL.
What does that do to their leverage ratio?
The total liabilities divided by assets ratio ticked up to 0.51 from 0.43 the previous year.
0.51 isn't panic territory, is it?
No, for a manufacturing company, anything under 0.6 or 0.7 is usually manageable, but the trend is the concern.
Right.
They are burning cash to grow and funding it with debt. The current ratio, which measures their ability to pay short-term bills with short-term assets, dropped from 1.49 to 1.15. The buffer is shrinking.
I'm looking at net debt.
Their cash position is about 684 million TL. Given the heavy borrowing, net debt is definitely rising. They are leveraging up to capture market share.
It feels like they're in a sprint. They are betting that if they build the capacity now, the market dominance will pay off the debt later.
That is the classic growth stock gamble. But they aren't just building generic factories. We should talk about their operational performance and R&D.
Okay.
They spent nearly 98.6 million TL on R&D this year.
What are they researching?
They are focusing on Topicon solar cells. These are high-efficiency cells that degrade slower than standard ones, and they are pushing the agro-PV systems we mentioned earlier.
All right, developing panels that let just enough light through for crops to grow underneath.
Yeah.
If they can crack the code on high-efficiency domestic manufacturing, that 5.7 billion in receivables won't matter as much because their margins will expand further.
That is the hope. And speaking of the future, what is management telling us?
The buzzword in the report is sustainable growth. But it seems practical. They are aggressively expanding the dealer network.
Yes, in December 2025, they launched CW Plus Bayi. Think of it like a premium dealership experience, like an Apple store for solar in cities like Diyarbakir, Kayseri, and Adana.
They want to be the household brand across Turkey.
Pretty much.
And I notice in the subsequent events, stuff that happened after the books closed in December, they're putting their money where their mouth is regarding that cell factory.
Yes, in January 2026, they injected another 150 million TL into the capital of CW Solar Cell. They are fully committed to this vertical integration strategy. There is no turning back now.
Before we wrap up, I want to check the fine print. You know I love the footnotes. Let's talk about shareholders' equity.
Shareholders' equity is strong at 13.9 billion TL. The equity-to-assets ratio is 0.49.
It dropped a bit.
It dropped from 0.57, which again reflects that increased leverage, but nearly half the company's assets are funded by equity, which provides a solid safety net.
And their related parties section. Any red flags there?
Not red flags, but yellow flags. There are significant transactions with companies like CW Academy and Oz Tech. We see rental agreements and service purchases.
Basically, money moving from the public company to other entities potentially owned by the same people.
Exactly. The audit report says it's within legal limits and market rates, but retail investors should always monitor related party deals.
Right. You want to ensure the profit stays in the company you own stock in.
That's it.
One last technical detail. The registered capital ceiling.
It sits at 4 billion TL. Since their paid-in capital is just over 1 billion, they have plenty of room to issue new shares or do capital increases if they need to raise more cash without a shareholder vote.
So let's synthesize this for the listener. We have a company with massive top-line growth and a skyrocketing net profit on paper.
But a company that is currently bleeding cash to fund that growth.
I'm trying to think of an analogy to make this stick.
Think of a farmer. CW Energy has bought a huge amount of new land and brand new tractors. Those are the assets. They've planted the biggest field in history. That's the production volume.
And they've sold the harvest before it's even fully grown. That's the revenue.
Right. But they sold it on credit. So the accounting books show a massive profit for the year because the crop is sold. But the farmer's bank account is empty because the buyers haven't paid yet.
Meanwhile, the loan payments for the tractors are coming due.
You've got it. That puts it perfectly. The harvest is promised, but the cash is still in the field.
So if the harvest comes in and the customers pay,
The farmer becomes the richest guy in town. If there's a drought or if the customers default, the debt becomes a heavy burden.
so for our listeners, CW Energy is an aggressive growth play. The 18% real revenue growth is impressive. The move to manufacturing their own cells is strategic brilliance.
But
But you have to watch that cash flow from operations line like a hawk next quarter.
if that number stays negative for too long, the debt will start to eat into that beautiful net profit margin.
Here's a provocative thought to leave you with. As CW Energy transitions from just assembling panels to manufacturing the high-tech cells inside them, a much harder, more technical process, will their profit margins expand enough to cover the cost of the leverage they are taking on? Or are they building a machine that is too expensive to run?
That is the multi-billion lira question.
We'd love to hear your take. Does the solar boom justify the debt? Or is cash king? Let us know in the comments. And if you found this deep dive helpful, please hit that like button. It really helps the algorithm find other investors like you.
And don't forget to subscribe so you don't miss our next financial breakdown.
If you want to support the channel and keep these deep dives coming, please evaluate our membership options or use the Super Thanks feature. We really appreciate it. Thanks for listening.